Good afternoon, everyone, and welcome to our 2025 Market Preview webinar. Consistent with prior Market Preview webinars, our goals today are to share with you what happened in 2024, as well as to provide some themes and market signals to watch for in 2025. Now, before we get started, the usual logistics. We have limited time for questions and answers today because of the content we will present. However, please do submit questions that are on your mind. If we cannot answer them live at the end of today's session, we will reach out to each individual and circle back with answers. Today's presentation will be recorded and uploaded on our YouTube channel, so you can go back and rewatch or share with colleagues as you see fit. As for introductions, my name is Greg Leonberger. Hopefully I'm a familiar face and voice at this point for those of you who joined these webinars before. I'm the Director of Research here. I will coordinate and host the session and also discuss the U.S. economy. Frank Valley is going to cover a special section we put together for this webinar today about Washington update, covering what to expect out of a Trump presidency as he starts his second term on Monday. James Torgerson will review fixed income, then Catherine Hillier and David Hernandez will cover U.S. equities and non-U.S. equities respectively. For the alternatives portion of today's webinar, Evan Fraser will cover hedge funds. We'd like to introduce Dennis Yu, a recently hired research analyst for real assets. He will cover real estate and infrastructure. And then finally, we will finish with private markets, private equity and private credit. Michael Carlton will cover private equity. Chad Schaefer will cover private credit. What we usually like to do for these webinars is start with the U.S. economy, and we will maintain that practice today and start by talking about a couple of things we're looking at. Number one, probability of a recession. The probability of a recession has dropped quite a bit over the last 18 months. As the Federal Reserve embarked on its rate hiking cycle roughly 2.5 years ago, there was a lot of fear that the higher rates would halt economic growth, reduce consumption, and as a result, put the U.S. economy into a recession. Now, while that probability of recession is still not zero, it has dropped precipitously, largely on the back of continued consumption, strong consumption patterns from the U.S. consumer. Consumption accounts for about 2/3 of GDP. So it's a fairly safe conclusion that when consumption is growing, GDP will continue to grow, thus keeping the U.S. out of a recession. Somewhat related to the reduced fears of a recession, as well as where some of the longer-term economic signals are settling out, rate expectations for 2025 have dropped. At this point, we are expecting 1 to 2 cuts from the Federal Reserve this year. However, what plays out in practice versus what the market expects going into the year is something to monitor, because when there's a lot of deviation from what the Federal Reserve actually does versus what the market has expected, that can create market volatility, oftentimes on the downward direction. Overall, if we look at some primary economic indicators, such as the Fed funds rate, GDP, unemployment, or inflation, we see a stabilization of most of these figures. The Federal Reserve will cut a bit more. However, we expect the Fed funds rate to settle somewhere around 3% over the next couple of years. GDP is expected to remain positive in the 2 to 2.5% range, whereas unemployment currently sits at 4.1% today. Longer-term projections hover right around that value. Inflation, the worst is certainly behind us. It may not be surprising to see a little bit of an uptick in inflation as 2025 plays out. However, we expect nothing like what we saw several years ago. And longer term, we think that inflation number settles in around the 2.5%, consistent with the Federal Reserve's long-term goal. So with an economic outlook out of the way, let's shift now to what we're going to see out of Washington over the next 4 years. And Frank, take us through what some of the expectations are for the Trump presidency.
Sure. Thanks, Greg. So starting on Monday, we're going to have a new administration in place, and with that new administration is going to come a new plan. So the Trump White House is going to have a list of policies that they're going to try to put in place over the coming years. And those policies are going to have an impact on both growth and inflation. And then there's going to be an associated impact on the deficit. So some of those policies are going to stimulate growth, like things like tax cuts and deregulation should increase growth in the economy. Other things are going to drag. So tariffs, as well as restricting immigration, should provide a little bit of a drag on growth. A lot of these policies are going to have the opposite effect on inflation. For example, tariffs and immigration should both increase inflation. But the big takeaway I want to do on this slide is that these policies, most of them are going to increase the deficit. It's an old problem. It's still going to be a problem. And we'll talk a little bit about that later. But overall, these plans are going to have mixed impact on the economy. So it's really important. We're going to have to pay attention to both the details and the sequencing of these policies to determine what the overall impact on the economy is going to be. So as I mentioned, we've got the new administration, but we've got the same old problem. The debt situation is not going away. The government has kind of kicked this can down the road a little bit, and that's not expected to change. So both the debt stock and the interest expense are both expected to increase with the new administration. Eventually, the U.S. is going to need to address this. They haven't really taken any action, but the bond market is already starting to take action. So the Fed has cut 100 basis points here in the third quarter. Generally, when you see interest rates get cut by the Fed, the rest of the curve follows suit and moves downward as the economy is in recession. But this time it's a little bit different. So the Fed took preemptive cuts in order to try to execute this soft landing. And what we've seen is back-end rates actually rise. And they've risen for a couple of reasons. The first is fears of reinflation. So did the Fed cut too soon and they weren't restrictive enough for long enough to stamp out inflation? And also some of the new policies are going to be inflationary. The other factor that's really driving those back-end rates up is increased deficits. Investors want to be compensated for holding long-term debt, particularly when the U.S. continues to add more and more debt to that stock. So all in all, that term premium that was gone for a long time is now back into the markets. Moving on to the credit sectors, there's going to be winners and losers. So on the winners side, winners are going to be those that favor deregulation. So airlines, financials should see some tailwinds from deregulation. Some other Republican favorites, defense. Generally, there's more defense spending during Republican administrations, and also traditional energy. We saw kind of a shift towards renewables under the last administration. I think with the Trump administration, you're going to see a shift back to more fossil fuels. Conversely, on the losers, I mentioned a little bit just a second ago, renewables, as we push back towards fossil fuels, renewables is one of those sectors that's teed up to be a loser. Healthcare, as the government scales back its support, and then another big target for them has been technology. Big tech is definitely under the microscope. And then in the middle, we've got the mixed sectors. I think these are going to be more name dependent and more mixed. One final sector to look at before moving on to fixed income is just a look at currencies. Trump has publicly stated he wants a weak dollar, and that's really for trade purposes. A weak dollar helps push U.S. goods outside the U.S. as more and more people import. However, his policies to date and what he's said have been more for dollar strength. So we've seen the dollar index rise over the fourth quarter. The other currency that's really done well since Trump has been was nominated to be the next president is digital assets. So digital assets have seen strength here in the fourth quarter. Trump was a very big Bitcoin hater. Now he's kind of a Bitcoin lover, and you've seen Bitcoin move higher since November. So to conclude, Trump policies are going to have mixed economic effects. Both the debt and interest expense are expected to increase with the new administration. The term premium is back as the Fed has cut short-term rates and long-term rates have moved higher. There will be winners and losers when we look at sectors. And finally, policies have pushed both the dollar and digital assets higher.
Thank you, Frank. And throughout the course of this afternoon's webinar, and we cover the different asset classes, there will be references to the new administration, new policies, and it's likely to be a more pro-business environment, less regulation, and that's really going to manifest itself across different asset classes in terms of expectations and themes to watch. Thanks for that, Frank. And then James, now as we look back on 2024 and looking forward to 2025, what are some of the things that you are following most carefully?
Thanks, Greg. Let's start with fixed income performance here. Despite rate volatility seen throughout 2024, fixed income returns were mostly positive. However, this elevated rate volatility and the increase in back-end rates that meant that long duration and more rate-sensitive indices fared rather poorly. I do want to point out, though, that leverage credit was a standout performer amongst fixed income in 2024, as the high yield and loan indices provided strong returns due to tailwinds from elevated yields, continued spread tightening, and resilient fundamentals. Finally, though, after the longest inversion on record, the yield curve normalized in Q4 as the Fed initiated its rate cutting cycle, which lowered front end rates. Frank just detailed a lot of this, but long dated rates moved sharply higher in the quarter, and they pushed higher despite the policy shift, since the Fed has minimal impact on the back end of the curve. There appears to really be no appetite for fiscal tightening from governments around the globe, not just the US. Rates may stay elevated as market participants take things into their own hands, which could signal the return of the bond vigilantes. Taking a look at yields here, despite that volatility we saw in 2024 from a rate perspective, yields were only marginally changed year over year across sectors. This is the result. The result of this is that the yield environment continues to be attractive for fixed income investors. All-in yields are compelling across multiple sectors, particularly in core bonds, leverage loans, and hard currency EMD. If you liked fixed income yields 12 months ago, you should still like them now. Now, spreads are a completely different story than yields. We may sound like a broken record here, as in this webinar last year, we bemoaned the lack of value in spreads, and that story has not changed. Spreads came into the year tight and found a way to grind even tighter. Across pretty much every sector, spreads are below their long-term averages and at near all-time tights, and valuations are subpar relative to history. However, this isn't necessarily unprecedented, as spreads can remain tight or range-bound for long periods of time. That is until a market shock sends them wider. Due to these tight valuations and paired with the attractive income currently offered, maintaining or adding diversification to fixed income portfolios will be the name of the game in 2025. And while valuations are tight, as we just mentioned, yield will always be the primary component of fixed income returns. With yields at their current levels, the majority of outcomes on a go-forward basis are still positive for fixed income. Looking at the yield to worst in the ag as of year end, it would take approximately 100 basis point move higher in spreads to create a negative return outcome. That is if rates remain unchanged. Rates have been moving higher as of late, and in the event that this continues, there would still need to be a significant move wider in spreads to create a negative outcome for investors. So moving on to some separate asset classes. Looking at emerging market debt. EMD has been a much maligned asset class over the years due to its heightened volatility and a bias towards US investments. It's fallen out of favor with dollar-based investors, and now there are renewed fears regarding a Trump administration's impact on emerging markets. While these fears could prove to be warranted, we can actually get a sense of how EMD will react during a Trump presidency, seeing as this is not his first rodeo in the White House. When looking at his last 4 years in office, the Trump administration was actually not the severe headwind to EMD that investors feared. Looking here, based on cumulative returns, EMD credit indices, which is hard currency and corporates, outperformed U.S. corporate credit and kept pace with U.S. high yield. With the higher starting yields offered today, another Trump presidency may not be the roadblock to positive EMD outcomes in 2025 and beyond. Let's move to the leverage credit market. Leverage loans continue to offer compelling yield and spread premium relative to high yield. While this premium compressed on economic fears this summer, it has since reversed course to more attractive levels. This premium is primarily the pricing in of the lower overall quality of the loan market relative to the much higher high quality, high yield market, but the excess carried offered, roughly 100 basis points as of year end, provides investors adequate compensation for this. As the market is poised for a higher for longer rate environment, this excess carry should remain in place. And then let's take a quick look at spreads. Similar to other sectors, spread valuation in loans are below historical averages. However, they are more attractive versus the all-time tight spread levels in high yield. Yields are compelling in high yield, but when you pair both the spread and yield premiums offered by loans, total return scenarios may prove to once again be more favorable here despite the heightened risks. So we did just mention how loans look attractive to high yield. Not to kind of throw cold water on that opportunity, but it is always prudent to evaluate the default environment and leverage credit, as it can be a signal for the broader health of the economy. Loan defaults moved steadily higher in 2024, while there was a large decrease in the high yield default rate. The spread between the default rates of the two asset classes is its highest level since data has been available at roughly 300 basis points. Loans finished the year with the default rate at about 4.5%, while high yield settled in at a 1.5% rate. There are a myriad of factors that drive this, but the large increase in loan defaults has primarily been driven by the proliferation of distressed exchanges and liability management exercises, which are not the same as an outright default. These financing solutions are done by distressed companies to avoid bankruptcy and oftentimes can lead to better outcomes for issuers. But this trend does bear monitoring. But the growth of these transactions has overstated the amount of traditional defaults at the headline level. Overall, defaults are forecasted to moderate for loans to roughly 2.75% in 2025, while high-yield defaults are expected to remain in line with where they're at today. Finally, we'll finish up with the opportunity and risk section. The opportunities and risks present in fixed income remain pretty similar to what we've discussed in the past, but there has been a marginal shifting of these risks. From an opportunity perspective, we've been beating this drum for years now, and everyone on this webinar is probably sick of us saying it, but bonds are still back. Despite the Fed initiating a rate cutting cycle, yields have moved higher and at the same level as they were entering the year. Fixed income still provides investors with attractive all-in yields despite rate volatility. This increased income cushion continues to provide downside protection for investors. And then IG corporate bonds, while spreads are tight, these bonds are still providing attractive carry. Fundamentals remain strong across the economy, and companies' balance sheets are on solid footing. And lastly, on the opportunity side, securitized credit. Securitized assets currently present value across multiple sectors. The asset class offers a yield premium relative to corporates, and spreads remain wide relative to the fundamental risks present. However, the key for making allocations in this part of the market is investing in collateral pools that have shown they can weather an economic downturn. And then on the risks piece, not going to rehash the inflation, the deficit. Frank did a great job doing that. Don't want to keep beating the tight spreads drum, but credit spreads are still extremely tight. As the delayed effects of the Fed's hikes impact the economy, there could be mounting pressure on borrowers. Spreads will likely remain tight until there's a significant downside scenario, and investors should get or stay diversified with spreads priced to perfection. And then Frank mentioned these as well, but multiple wild cards, which is uncertainty around the Trump administration and obviously heightened geopolitical risks. So while there are plenty of opportunities and risks in fixed income, the name of the game for fixed income investors in 2025 is to be diversified across your allocations.
Thanks, James. And I think you said it best a couple of slides earlier that if you like bonds 12 months ago, you still like bonds today. All-in yield across the spectrum is attractive and provides meaningful income for investors. And what we've seen from an asset allocation perspective across our client base is we've seen some trimming of equity exposure in favor of fixed income exposure, just because you can get such significant income from bonds today with a bit less volatility. So that's a story in fixed income. Now moving over to U.S. equities, Catherine, no pressure, but in 23 and 24, U.S. equities both delivered more than 20%. So curious to hear your outlook for 25 and if a similar number is realistic.
Thanks, Greg. So entering 2024, most investors thought it would be highly unlikely to see a second year of 20+% returns for the U.S. equity market. But as Greg mentioned, in defying these expectations, the S&P 500 advanced 25% in 2024. And as we'll see in subsequent slides, the narrative for U.S. equity markets held for large chunks of the year, with concentration, AI, growth, and momentum, all terms repeatedly referenced. Although large cap equities led, small cap equities generated brief periods of outperformance, primarily driven by expectations for lower inflation, Fed rate cuts, and the outcome of the presidential election. Despite advancing 11.5% measured by the Russell 2000 shown on this slide, small cap equities remain in one of their longest stretches of underperformance relative to large cap equities historically. This period was punctuated in December as the Russell 2000 posted its worst relative December versus the S&P 500, trailing by nearly 6% in the month of December alone. Now, from a sector perspective, although growth equities led the U.S. market, with the Russell 1000 growth outperforming the Russell 1000 value by 19%, 7 sectors posted double-digit returns across both cyclical and defensive sectors. The AI narrative provided a boost to cyclicals like information technology, which is a very similar story to what we heard in 2023, while the rate cut narrative supported the financial sector. And the more defensive utility sector benefited from both of these themes, but still underperformed the index return. The idea of concentration mentioned earlier evident here as the best performing sector, the growth-oriented communication services sector, outperformed the value-oriented material sector, the worst performing sector, by 40%. With this slide here, we'll briefly recap a few of the key events that happened in 2024. Throughout the year, markets were sensitive to economic data and Fed rhetoric. Again, a similar story to 2023. Thick inflation triggered a brief market sell-off in the second quarter that was followed by an all-too-familiar AI-fueled rally. On a softer inflation print in July, markets saw a rotation out of the mega-cap market leaders. This market breadth was welcomed as small-cap equities rallied. The Fed cut rates in September, but uncertainty around the next presidential election led to a more muted market reaction. Then, as Trump emerged as the next president, a risk-on rally took hold. Crypto assets surged, as Frank mentioned earlier, as did Tesla. Despite a third rate cut in December, markets fell to close the year as the Fed took a more hawkish tone and expectations for interest rate cuts in 2025 were slashed. Amid all of this, the S&P 500 achieved 57 all-time highs in the year, while the Russell 2000 achieved just one, and it's only its first all-time high since 2021. Concentration is a word markets cannot escape, as I mentioned earlier, and it doesn't just pertain to large cap equities. With historical levels of concentration, as the top 10 positions in the S&P 500 surpassed 37% of assets at the end of 2024, the market cap weighted index outperformed the equal weighted index by over 12%, its third best showing behind only 1998 and 2023. Maybe not surprisingly then, the number of stocks that have outperformed the index, less than 30% in 2024, it also sits near all-time lows since 1999. And as most of us know, the source of this concentration has been the strength of the Magnificent Seven. After contributing over 62% to the S&P 500 return in 2023, this cohort of companies contributed another 53% to the index return in 2024. As we mentioned earlier, however, we did see brief periods of strength in the broader market in the third quarter, as well as post-election. Market breadth hasn't persisted, though, as concerns about the future path of interest rates, economic data, and geopolitics repeatedly led investors back to these mega-cap stalwarts, given their strong earnings growth, which we'll see in a subsequent slide. Moving forward, it's important to note that these companies trade at lofty valuations, so any sign of weakness in earnings may make them more susceptible to a market or to a pullback, whether it be iPhone sales from Apple in China or trouble with manufacturing of the Blackwell chip for NVIDIA. Now, after 2 consecutive years of 20+% returns, what might be in store for the U.S. equity market in 2025? Although this is difficult to predict, the current bull market, which began in October of 2022, does not appear extended historically. At 27 months in duration, it falls below the historic average length of a bull market dating back to 1932. As the length of these bull markets has varied, what might support the continuation of this bull market going forward? Now, this question may be partially answered by considering expectations for continued U.S. economic strength. In the last several months, 2025 GDP forecasts for the U.S. economy have been revised upwards, now over 2%, while forecasts for other major developed economies, including France and Germany, have been revised downwards as these countries battle issues like political instability and trade tensions. As a result, investor sentiment is mostly bullish on the U.S., as seen by record inflows into the U.S. markets last year. And another way to possibly answer this question is to look at earnings growth estimates. In 2024, the Magnificent Seven is expected to contribute materially to the earnings growth of the S&P 500, while also surpassing the earnings growth for international developed and emerging markets. While this is expected to slow in 2025 and 2026, the remaining companies in the index are expected to see a rebound, which should continue to support strength across large cap equities. Also worth mentioning here, earnings growth estimates for small cap equities are again negative for 2024, which has weighed on their relative performance within the U.S. equity market. If estimates for 2025 hold, which are relatively strong here at nearly 20%, this may support strength for small cap equities going forward. And as we have spoken about the strength of the U.S. equity market over the past 2 years, it is likely no surprise to anyone that valuations appear expensive by historical standards, particularly among large cap equities. However, if we dive a little bit further and to find pockets of value within the U.S. equity market, we still see that small cap equities are attractively valued relative to their large cap peers, while value equities also remain attractive relative to their growth counterparts given the strength of the growth indices. So we'll wrap up here with some opportunities and risks to U.S. equity markets. Given the recent market strength we've discussed, although the future returns for U.S. equities may be more muted than the 20% returns we've seen, 20+% returns we've seen for the last 2 years, the backdrop for the space remains positive relative to other geographies given a new pro-business administration that Frank discussed that may spur economic growth and M&A activity. Although the U.S. market appears expensive, as we have mentioned as well, there are pockets of value, particularly among those small cap equities, given fundamentals and relative valuations, but these companies must see a rebound in earnings growth to gain persistent favor with investors, which has not come through as we showed on the previous slide a couple slides ago. Despite a constructive outlook, risks remain as some of the proposed policies of the new administration, including increased tariffs and immigration reforms, may be inflationary. We have talked about some of the market extremes in the U.S. equity market today, including concentration and valuations. So any acceleration in inflation in tandem with the structurally higher rates that have been discussed and a stronger U.S. dollar may lead to a market correction in 2025. Also, as we showed earlier, investor sentiment has been exuberant for U.S. equities, and this can be a warning sign for markets going forward as well.
Catherine, that combined with the concentration risk are certainly themes to watch for in 2025. Overall, though, considering that new policies under Trump will be more pro-business, if earnings growth can stay positive and meet or exceed expectations, I do think it's realistic to expect a positive return out of U.S. equity markets. Though, to be honest with everyone, 20+% for multiple years in a row is not the most realistic expectation. So we'll certainly take 23 and 24, but go into 25 with a bit more muted expectations for U.S. equities. David, we've covered the U.S. side of things. Now, as you look into 2025 for non-U.S. equities, what are some of the things you're watching most carefully?
Yeah, we'll talk about some of what we're watching in 2025, but to revisit 2024 briefly, for the full year, non-U.S. equity benchmarks produced positive returns, though they did have negative performance there to end the year in the fourth quarter. Looking at this performance page, I'd point to 3 key trends that we saw last year. The first, similar to what happened in the U.S., small caps underperformed large caps in both developed as well as emerging markets. The second, emerging markets beat out developed markets, largely boosted by some key Asian country performance that I'll talk about in a couple of slides. And then the last point is that currency returns have detracted from U.S.-based investors as the dollar moved higher in 2024. Now, that move higher in the dollar was not in a straight line. In fact, there were abrupt shifts to currency movements throughout 2024. As an example, developed non-U.S. currencies returned 6.4% in the third quarter versus the dollar, and they followed that up with a 7.5% currency loss to end the year. Now, that end of year was heavily influenced by the presidential election with President Trump getting victory and the market really trying to attempt to anticipate what type of policies the incoming administration would have. Now, in some upcoming charts, we'll talk more about President Trump's policy and what it might mean for non-U.S. equities. But first, I reference some key Asian countries boosting EM performance, so let's take a look at that. Taiwan, China, and India all generated double-digit returns in 2024. While volatile for the entire year, China returned 19% after 3 straight calendar years of double-digit losses. Taiwan was the best performing country. Good job, Taiwan. Produced a 34% gain, and that even beat out the S&P 500, which generated a 25% gain. Now, my colleague, Catherine, has already discussed some of the issues around concentration within U.S. markets. I thought it'd be helpful to provide a global context to that and look at concentration from a total global equity perspective. So if we look at a global equity index, the 5 largest stocks in that index are Apple, Nvidia, Microsoft, Amazon, and Meta, represented here by the purple bars, and they comprise 16.6% of the MSCI ACWI index. The top 5 non-U.S. countries, Japan, UK, Canada, China, and France, make up 15.5% of that index. Now, certainly, these companies have been additive to portfolios, but on a forward-looking basis, we think it's important to maintain non-U.S. equity exposure as a way to diversify from heavy individual stock concentration. Now, given that concentration, as Catherine said earlier, valuations are high within the U.S. equity space. You look at S&P 500 across 6 different valuation metrics. All of them are in the top decile of expensiveness over the last 20 to 25 years. We compare that with non-U.S. equities, and you see valuation metrics that are around historical averages. Non-U.S. small cap, a little exception where it's trading just below historical averages. Now, any good researcher will tell you that valuations mean diddly squat for short-term performance all by itself. But certainly, if we think about 2025, we think the S&P can and will go higher. But valuations are indicative of longer-term performance potential. And I think this serves as another reason why long-term investors should maintain diversification with some of the non-U.S. equity exposure. Okay, so that's me plugging long-term focus. Now let's talk about short-term. Let's talk about 2025. We got 4 key themes for non-U.S. equity markets. First is Trump policy uncertainty. The second is economic weakness, two key regions that we're looking at and potential impacts of Trump policy. And then the last 2 are more positive. We see good momentum in Asia ex-China, and then some of the earnings growth outlook in 2025. Now, tariffs are a key threat to non-U.S. equity markets. After the U.S. November election, the uncertainty connected to U.S. trade policy jumped similar to the levels that we saw during President Trump's first term. In 2018 and 2019, we'll remember the phrase trade war often being used to describe the relationship between the U.S. and China. And President Trump has already threatened several countries with tariff, which all else being equal would have an inflationary impact and likely serve as a headwind to economic growth. Paradoxically, President Trump has also advocated for a weak U.S. dollar, but several of his policies, including deregulation and tax cuts, are likely to encourage U.S. economic growth as well as higher interest rates, both of which would be supportive of a strong U.S. dollar. Now, when accounting for inflation, the greenback is already trading at 30-year highs plus 2 standard deviations above its longer-term average. So that makes medium-term or long-term strength from the U.S. dollar unlikely, but we would expect to see some volatility in currencies in 2025. Now, there are 2 economies that we think are both prone to policy headwinds from the U.S. as well as that are currently experiencing economic challenges. Firstly, the European economy is expected to grow at a tepid 1% in 2025, and tariffs from the United States would serve as a drag on that tepid activity. Additionally, Europe is facing challenges from China in 2 major ways. First, China has become a major trade competitor, especially we've seen this in the automobile industry. And then second, China is a key export partner. So it's estimated that 8% of Europe's weighted revenues are directly exposed to China. And if we think about China, consumer activity out of that country has remained depressed. Last year and even 6 to 12 months prior to that, the Chinese government had implemented key stimulus measures, and this has failed to cause a rebound in consumer confidence and has remained depressed since its 2020 levels. In his tariff threats, President Trump has specifically called China, warning a 60% trade levy. Now, overall, we think President Trump's current policies are a headwind to non-U.S. equity performance in 2025, particularly Europe and China. We would also note that implementation of those policies is likely to look different given President Trump's history and inclination towards negotiation tactics. So as a result, we would caution investors against making investment decisions based on proposed policies. Moving to some of the positives within non-U.S. equities for 2025, Asia ex-China has experienced positive momentum the last 2 years. We expect some of that to continue here in 2025. I mentioned Taiwan earlier. Taiwan, best performing country, producing a 35% return. This country has benefited from the AI boom as it produces more than 60% of the world's semiconductors, more than 90% of the advanced chips that are used globally. Additionally, it has gained market share in some other hardware exports like servers and graphic cards. And Taiwan is likely to perform well should this AI momentum continue into the years ahead. Japan. Continue focus here on shareholder return, and that has moved equities higher broadly. As an example on shareholder return, announced buybacks from this market has increased over the last 5 years, north of 12 trillion yen. We have seen companies that institute buybacks outperforming broader indices. So, for example, the MSCI Japan Buyback Yield Index, which is an index comprised of companies that are doing buybacks, that index returned 20% in 2024 compared to 8% for the MSCI Japan Index. So improvement in shareholder return are expected to continue, and so we think of that as a positive for that market. Another positive for that market is earnings growth in Japan. It's expected to be additive in 2025. And in fact, all major non-U.S. regions are expected to have positive earnings growth. Now, this is a departure from the last 2 calendar years where we've seen mixed results throughout the world. It's important to note that these are estimates, and these estimates are likely to be revised, and they can be revised downward. But at their current levels, they're supportive of positive returns for non-U.S. equities in 2025. Let's wrap up this section with the opportunities and risk. I talked about the positive earnings outlook. Hopefully that's sustained and that can be supportive of equity returns next year. Asia ex China has a lot of positive momentum. We talked about Japan. We talked about Taiwan. India is a market I didn't talk about today, but that has some positive demographics, good growth outlook, interesting market there, though valuations are high. From a risk perspective, we talked about Europe having some challenges from an economic perspective. There's also some political uncertainty. On the bright side, the central bank is expected to cut rates, which can be supportive of economic growth. President Trump's policies, a lot of uncertainty there. Any communication from President Trump can also cause some volatility on a short-term basis. And then China continues to struggle in terms of getting that consumer back to some renewed confidence.
Thanks, David. And I think the year could really shake out to the balance between how positive earnings actually end up being versus some of the Trump's policies and how that could challenge some of the currency elements of the return. So things to watch for, no doubt, going into the new year here. Let's transition now to alternatives, and we'll start with hedge funds. Evan, pretty good year for hedge funds. So tell us what you saw for 24 and what you're looking for in 25. And it appears we might be having some technical difficulties with Evan. Evan, we're going to skip through hedge funds here and hope to get you back online, and we'll go to real assets now. To the audience, I apologize for moving around a little bit. This is technology that's best sometimes. So anyways, Dennis, let's go into real estate and infrastructure. And same question I asked Evan, what do you see in 24 and what are you watching for in 25?
For sure. Thank you, Greg. For real assets, I'll start with real estate. In terms of performance, as a reminder, private real estate is reported on a lagged basis. For the third quarter of last year, the NFI Odyssey Index achieved a total gross return of approximately 0.3%, marking the very first positive return in the past 8 quarters. This was driven by 1.1% income growth, partially offset by 0.8% decline in appreciation. We also just received the preliminary fourth quarter report from Equities this Tuesday, showing a total gross return of 1.16% for the fourth quarter of last year. Notably, all sectors except office generated positive return in the third quarter. Overall, we are observing less valuation pressure from capital markets and continued strong property level fundamentals across most sectors. We are confident that we are at or have already passed the inflection point of the down cycle. The page here highlights the significant rise in cap rates, reaching the highest average property income yield in the past 10 years, signaling one of the most attractive entry points for real estate investment in recent history. After years of compression due to strong demand and rising valuations, cap rates have reversed since 2022, driven by higher interest rate and financing cost. This shift presents a very compelling opportunity for investors to capture improved income-generating potentials. Switching focus to the real estate debt market, this slide actually illustrates the reopening of debt market, evidenced by increasing transaction volumes in commercial real estate debt originations. After a period of subdued activities in previous years, transaction volume have rebounded in later 2024, reflecting the improved liquidity and growing confidence in the market as access to financing become more available. Meanwhile, we also see improving value across most sectors, with notable recovery in apartments, retail, industrial, and self-storage properties. However, the office sector remains as an outlier as values continues to decline due to weaker demand and structural challenges in the post-pandemic environment. The upward trend in other sectors showcases resilience, particularly in sectors supported by favorable demand dynamics. Taking a closer look at these sectors, we see a very differentiated outlook across sectors, highlighting the relative strengths of industrial, apartment, and retail. Specifically here, industrial assets stand out with strong projected NOI growth, while retail leads in cash yield and occupancy. As a result, sector-focused strategy and funds are likely to benefit from greater flexibility and opportunities to capitalize on market disparities. To summarize real estate section here, the current market environment offers opportunities to acquire high-quality assets at very attractive valuations, particularly value-added strategies, improving deal flows as financing conditions improve, coupled with strong demand for specific sectors and alternatives, creates potential for portfolio diversification and growth. Challenges persist in office sector with declining values and leasing pressures due to remote work trend. Core managers face constraint from unfavorable debt structure and limited flexibility, while rising 10-year treasury rate could also increase borrowing costs and further pressure asset valuations. Moving on to infrastructure here, we see a 3.4% quality return for private infrastructure with a solid 10.9% return over 1 year and consistently performance over longer periods. This indicates steady and reliable performance for private infrastructure, making it a very attractive option for investors seeking stability and inflation hedging. For particular themes, we saw this anticipated surge in U.S. power demand projected to grow by more than 70% by 2040, driven by rising demand from sectors like data centers and hydrogen production. This growth reflects the urgent needs for infrastructure investment to meet expanding energy requirement, particularly in emerging and high energy consuming sectors. Here, if we dive deep into sectors here, investor focus in infrastructure over the past decade has actually evolved significantly, with a notable increase in digital assets such as data centers and connectivity networks, while renewable energy consistently capture a significant share of global transactions, reflecting strong demand for sustainable solutions. Digital assets are now emerging as the leading growth driver. This shift underscores the rising importance of technological advancement and digital transformation in the infrastructure investment landscape. Overall, infrastructure investment present compelling opportunities as hedge against inflation. The rise of generative AI and digital services is driving significant demand for digital assets. Key risks include macroeconomic and regulatory uncertainties. Additionally, challenges in asset quality and operational execution, especially in energy-intensive digital infrastructure like data centers, highlights the need for skilled asset selection and management to achieve desired returns. Back to you, Greg.
Thanks, Dennis. And circling back to the real estate discussion that you did first, I think it's safe to say the worst is behind us now with real estate, with perhaps the exception of office, but hopefully the upward trend of returns that we're starting to see continues for the foreseeable future. In infrastructure, there's always a demand for this, and as the economy evolves, as technology evolves, there's a growing need for data centers and energy. So again, more opportunities in infrastructure space. So what we're going to do now is we're going to move forward with the private markets discussion. We'll start with private equity, and then private credit, and then hopefully we have Evan back online, and we'll circle back to hedge funds to wrap up this afternoon's webinar. But Michael, take us to private equity. Again, same question I've been asking every analyst. What you saw in 24, and then what are some things you're watching for in 25?
Yeah, thanks, Greg. We'll start as always with performance, which is updated here through 9/30. So Q3 was positive across buyout, expansion, and venture, both within the U.S. and globally. U.S. expansion had the strongest quarter of the bunch, with a positive 5.7% return. And as we called out last quarter, the booming public markets have outperformed PE in recent years, but PE is outperforming over the last 10 years, as seen in the far right column here. U.S. private equity has compounded at a 15.1% annual rate versus 13.4% for the S&P 500. As illustrated in this chart, aside from the anomalous period during the COVID era, the median PE fund has consistently outperformed public market equivalents across nearly all of the 15 vintage years displayed. This consistent outperformance underscores the resilience and long-term value creation potential of private equity investments, even in varying market conditions. Notably, top quartile managers have delivered superior performance across all vintage years shown, highlighting the significant alpha generation possible when investing with leading PE managers. This reinforces the importance of manager selection in capturing outsized returns in the PE space. Now here looking at private equity deployment, which ended 2024 on a positive trajectory. Excluding the anomalous COVID-induced boom of 2021-22, last year marked a historically strong year of PE deal-making, though this was driven in meaningful part by add-ons. This robust activity overall underscores the continued confidence in the private equity market and its capacity to identify and execute compelling investment opportunities despite broader economic uncertainties. Now looking at the GP-led secondaries market. So in the evolving landscape of PE exits, general partners have increasingly sought alternative liquidity strategies to provide flexibility and maximize value for their investors. One such strategy gaining prominence is the use of the secondary market, particularly GP-led secondary transactions. In 2024, GP-led secondaries accounted for just over 7% of the total PE exit value. This trend reflects a growing acceptance and utilization of these transactions as a viable exit route, enabling GPs to extend the holding period of high-performing assets, offering liquidity to existing investors, and secure fresh capital for new investments. The rise in GP-led secondaries also highlights the strategic adaptability of private equity firms in response to market conditions and investor needs. So this chart provides a comparative analysis of the median enterprise value to EBITDA multiples for the S&P 500 and private equity deals in North America and Europe, which are categorized by deal size. It highlights the valuation differences across various segments of the market. The data reveals that the S&P 500 and PE deals exceeding $1 billion are trading at multiples over 15.5 times, indicating robust valuation levels in the upper end of the market. In contrast, smaller deals, particularly those under 100 million, exhibit significantly lower multiples, hovering just below 10x. This disparity underscores the attractive entry points available in the lower middle market. Managers operating in this space can capitalize on the favorable valuations, potentially acquiring high-quality assets at more reasonable prices, which can translate into greater upside potential and returns for investors. Since the November 2022 release of ChatGPT, the venture market has experienced a significant surge in AI and machine learning deals. This trend highlights the rapid acceleration of interest and investment in these technologies as businesses and investors alike recognize their transformative potential. This surge in AI and ML deals spans a wide range of sectors, from healthcare and finance to retail and logistics, demonstrating the versatility and broad applicability of these technologies. And then we will wrap up here with opportunities and risks. So beginning with the risks, there is a growing prevalence of mature funds. Globally, around 52% of all PE funds have been in operation for 6 years or more. And as these funds approach the end of their life cycle, GPs may need to accept lower valuations to be able to close out of these products. And macroeconomic uncertainty certainly abounds. While interest rate cuts in 2024 did help stimulate deal making, the outlook for further reductions remains uncertain, and any spike in inflation could certainly hamper M&A activity. But on the opportunity side, current signs on the M&A side are pointing positively, and the recovery continues, with 2025 set to surpass or primed to surpass 2024 in terms of overall exit value. And then valuations in the lower middle market. So entry pricing still remains down, especially in the lower middle market, creating broad, attractive opportunities for our managers to create value through strategic acquisition, operational improvements, and organic growth initiatives. And with that, I'll go back to you, Greg.
Thanks, Michael. And if we see that continued trend of this uptick in deal making and stronger exit activity, that's just going to enhance the case for private equity and make it a more attractive asset class for investors, either to allocate more towards or to allocate towards for the first time. But supporting all this, of course, is the private credit market. Chad, I know you've been busy doing a lot of client meetings, doing a lot of manager due diligence work. So what are you looking at for the coming year?
Sure. Thanks, Greg. As always, we'll start with performance. And like other private markets, again, these returns are lagged through Q3. But if you look at the results through the third quarter, we continue to see private credit consistently return a healthy return for investors, somewhere around the run rate of 2.5% to 3% per quarter. And most of that is driven by healthy portfolio yields coupled with limited losses on the downside. For the trailing 1 year period through 9/30, broad private credit delivered about 9.7% net to investors, while middle market direct lending, where we have a lot more of our exposure, returned almost 12% over the last 4 quarters. Now, if you look more broadly through this 1 year period, everything has performed particularly well. But if you look further out, 3, 5, 10 years, private credit has delivered a pretty healthy return premium to really any part of the traditional fixed income markets. And again, you're getting compensated for the additional risk you're taking here. Now, as we think about the current opportunity set and focus specifically on direct lending, we have to first acknowledge that spreads have tightened in from their wides of 2023. Talked about it on the traditional fixed income side, see it again in the private credit side as well. To put this in perspective, more than 80% of new issue sponsor-backed loans were issued at spreads north of 600 basis points in the second half of 2023. By comparison, that number is down to about 20% or even inside of that now. And about 60% of new loans are getting done at levels of 5.5% or tighter on a spread basis. Now, part of this tightening is a result of increased competition from the leveraged loan markets, and it's forced direct lenders and the private credit side to tighten in spreads on the deals in order to get them done and win against the public markets. But part of this is also a reflection of that time period from 2023 where there was a significant level of uncertainty and the spreads were significantly wider to reflect that. Now, those that were invested in private credit ultimately benefited from deal flow in that time period at those wide levels, but we've settled in now around 525 basis points or so across direct lending. And I think that's sort of the stable levels we should expect going forward. Now, of course, there's outliers on either side, tighter and wider, depending on the part of the market you're in or the quality of the deals. But generally, I think you should expect somewhere around SOFR plus 525 basis points as the norm. Now, while acknowledging spreads are tight and tighter from a year ago, we can still look at the all-in yields and say, well, they're pretty attractive today. Yields in private credit on an unlevered basis are around 10% or so today, maybe a little bit higher than that. And there's a healthy premium, again, to the traditional fixed income side from a yield perspective. Now, there was a period of time in 2022 as the Fed was raising rates where that gap narrowed. But again, you can see that it's widened out again. And again, the all-in yield for private credit is at a significant premium or a healthy premium to leveraged loan markets, other parts of fixed income. Now, as we look forward, there are a number of positive tailwinds to point to that continue to support private credit beyond just the yield you can earn today. I'll touch on 2 of them here, but there are others. The first one is expectations on activity within leveraged buyout markets in private equity. In 2024, we saw a modest uptick there in the number of buyouts that were financed throughout the year. In aggregate, those levels are still far below the peaks we saw in 2021 and early 22. Now, no doubt the Fed rate hiking cycle, some of the economic concerns have impacted M&A volumes and private equity, but there's also a number of reasons to expect that volumes in 2025 will certainly exceed 2024. You have a new administration that should support M&A, potentially lower interest rates from here. We have significant dry powder in private equity as well that needs to be put to work at some point. So all of that should bolster returns or origination going forward. Now, additionally, it's important to note that private credit is still the primary source of financing for most buyout deals. If you look at this on a volume or a dollar weighted basis, it's much more balanced between private credit and syndicated markets. And that ultimately makes sense, right? The larger deals get done in the leveraged loan market, tighter spreads, and so it looks more balanced there. But if you look at the average private equity deal, the majority of that's still getting done in private credit markets, and that should continue going forward. So in summary, from an origination perspective, 2024 was higher than 2023, and we expect 2025 to be higher than 2024 given all these dynamics. One other tailwind I'll just touch on briefly is it's a reminder, there's a healthy maturity wall out in 2027 and 2028 for leveraged loans and private credit. Now, this may not affect origination volumes in the first half of this year, but a lot of these loans get refinanced inside of 2 years leading up to that maturity. So if we see a cut in rates, significant volume on the refinancing side of origination could pick up. And again, that's another tailwind for private credit overall. Now, of course, there's a lot of positives, but we should also look at some of the risks. And there's really two metrics that we follow pretty closely from a credit risk standpoint, and I'll touch on them on the next two slides. The first is PIK interest levels. So PIK interest means this is the proportion of interest paid on loans that's not being paid out in cash, but instead being tacked onto the principal balance and ultimately paid at maturity. Historically, this was sort of a canary in the coal mine, an indicator of deteriorating credit quality and stress building. But however, more recently, deals are getting done with this as a component right at the onset of a new loan. So these are borrowers not going through any stress at all, and they're just given that flexibility to tack on a portion of the interest as principal instead of paying it out in cash. So while, again, you can possibly look at this and significant increases in this level as a measure of stress, I think it's less of a reliable indicator going forward. So you see PIK interest at 7% today. It's above long-term averages, but well below levels that we would deem as elevated stress levels within PIK interest. Now, if you look at a different measure, one that's probably a better indicator of distress, that's non-accrual rates. So these are loans not paying any interest at all and are likely going to go through some period of restructuring. So looking at that data, we're about 60 basis points today. That's inside of long-term averages and certainly well beneath peak levels we saw in COVID and during the GFC. So again, all that being equal and taking into consideration the downside of the credit risk in private credit seems to be pretty healthy at this point. And again, coupled with yield, it's pretty attractive on an absolute and risk-adjusted basis. One final theme I'll just touch on briefly is this theme or concept of blurring lines between public and private. A lot of this is being driven by regulatory pressures, and it's partially a reflection of the tight spreads across public fixed income, forcing this sort of movement towards private credit in areas that historically were not prominent players or diminished given regulations. Again, the banks have had to adjust, and where they were typically seen as an adversary to private credit managers in the past, are now creating more of these partnerships, more symbiotic relationships where they can both mutually benefit. You can see some of the big logos on this page, but there were 14 major bank partnership announcements with private credit last year, leveraging the origination capabilities of the banks with the dry powder and resources of private credit to create a win-win scenario. We've also seen some of that on the insurance side. Looking forward, I think you should expect this to be a theme that continues going forward, this general blurring of lines between public and private credit markets. Ultimately, it creates more opportunity and I think a net positive overall for private credit in general. Just quickly, I'll wrap up on opportunities and risks. The big takeaway here is private credit portfolios remain healthy overall. We're not seeing major signs of deterioration or building credit concerns. Expected returns remain attractive on both an absolute and risk-adjusted basis. And then on the flip side, we've noted competition has increased pretty clearly. Spreads are tighter, but there's still a healthy premium to traditional fixed income markets compensating for that additional credit risk you're taking. So again, we expect 2025 to be a busy year for private credit and think all in private credit is well positioned to deliver for investors. Kick it back to you, Greg.
Thanks, Chad. And I want to see if Evan's back online here. Evan, are you here?
Yeah, Greg, can you hear me?
Yeah, let's go. So I'm going to go back to hedge funds, ask the audience just to bear with me for a minute here as we navigate towards it.
Well, it's funny. So Catherine said the technology has been doing well lately. It certainly hasn't been for me. So I apologize for that. And thank you all for bearing with me.
Take it away.
Yeah, thanks, Greg. We'll get ready to go here. We can look at the full year 2024 and 4Q returns for the entire hedge fund spectrum on this slide. So the fourth quarter was again positive for all hedge fund strategy types. Put right strategies, we talked about those in the past. They continue to lead the hedge fund space. That index was up nearly 4% for the quarter and around 18% for the full year. There's more equity beta embedded in those strategies versus any of the other ones here on this list. So when the equity markets are strong, those strategies will be as well. And then to that point, the equity hedge index, so again, more equity beta there, up around 12% this year after gaining almost 2% in the fourth quarter. Global macro strategies actually led the hedge fund space in December as stocks and bonds kind of pulled back a little bit, but the full calendar year return for that index was only around 6%. And then the last thing I would call out on this slide would be merger arb, which was also up around 6% for the full year, but did post a 2% return in 4Q. And I think there's a lot of reason for optimism as it relates to that space going forward. And we'll detail that in a slide or two here. So let's explore hedge fund positioning a little bit, specifically gross and net leverage levels. So in previous webinars, we've talked about how hedge fund gross leverage levels have been elevated relative to history, really over the last year or two. So in the fourth quarter, we actually saw gross leverage come down about 10 percentage points to roughly 200%. This isn't atypical. We often see degrossing going into year end. But it is interesting to see that pretty much all of this change was a reduction in short exposure, because you can see that the net exposure number actually ticked up by essentially the same amount that the gross figure went down by. So not a huge change. Gross leverage is still in the 98th, 99th percentile of levels dating back a decade and a half despite this decrease. And then the increase in net leverage brings that figure to right around average relative to history. Okay, so a big reason behind strong performance from equity hedge fund managers last year that we looked at earlier was the positive long-short spread that we saw, which measures the performance differential between the most prevalent long and short positions within hedge fund portfolios. So we can see that the top 50 hedge fund longs outperformed the S&P by about 12 percentage points last year, and the top 50 shorts underperformed the S&P by about 8 percentage points. And that actually makes 2024 one of the strongest years on record for long-short alpha. So certainly a positive that managers have been able to execute on both sides of their books, especially after many years of challenges, especially when it comes to the short side. So I mentioned that merger arb may be an interesting space, in this new year. You can see here some of the big deals that have either been canceled or delayed recently due to various concerns from the Biden administration and the regulatory agencies. The U.S. Steel deal is one that folks are probably pretty familiar with. That's been much in the news. That one was just blocked, I think, earlier this month due to labor-related concerns, among other things. And this kind of regulatory uncertainty creates problems for merger arb managers who are trying to essentially take advantage of price dislocations that are caused by these deal announcements. And that's evidenced by the higher spreads that we've seen over the last few years. Now, that being said, as you mentioned earlier, I think, Greg, we're likely to see shakeups at a major regulator going forward, given the new administration. That should lead to more deals getting done and more opportunities for merger arb managers going forward. And then one other thing we thought was worth calling out was the rise of zero-dated options. These are essentially options contracts that expire on the same day that they're traded. So they're highly sensitive to price movements in the underlying asset, typically used for speculation and some of the more risky options available. And here we have data from the CBOE. We can see that for the first time ever, zero-day options made up more than 50% of total option volume in the fourth quarter. Now, this trend has mainly been driven by retail investors. Most institutionally focused asset managers, like the ones we work with longer dated options, but the increase in popularity of these zero-dated options does bring with it some risks. Namely the potential for an event like an unexpected Fed decision to trigger some sort of market swing, which could create a feedback loop as option sellers rush to hedge their positions. That could lead to kind of widespread market losses. So certainly an interesting phenomenon here that we're looking at, but again, more on the retail side as it relates to actually who's using these options. So I'll wrap up quickly with risks and opportunities within hedge funds. We talked about the rise of zero-dated options, relatively high gross leverage levels. Other risks include the macroeconomic and geopolitical issues that have been mentioned earlier, and then crowded trading across equity and multi-strat managers. We've talked about this a little bit in the past, but there's a good deal of overlap across some hedge fund books as far as positioning goes. A lot of these are the positions that, have seen significant price appreciation over the last few years that now make up a significant percentage of major indices. And so if we see widespread deleveraging across hedge funds, that could have some impact on the overall equity market. And then as far as the opportunities go, so we discussed the return of deal making, what that might mean for strategies like merger arbitrage. Trump's election creates clarity in general as it relates to future policy, which gives managers more insight into areas of the market that might perform best going forward. We've certainly seen that play out in areas like cryptocurrency and certain segments of the equity market. Kind of to that point, equity long short managers could be poised for continued strength given a short rebate that remains relatively high and the potential for increased market dispersion. And then just wrapping up, as we always do in the hedge fund value proposition more broadly, diversification of returns, downside protection, flexible mandates. I think, Greg, you mentioned earlier that 2024 was a solid year for hedge funds. They were able to deliver on that mandate, and I suppose we'll see if that continues into this new year and beyond. And with that, I'll turn it back over to you, Greg, and apologies again for the tech issues.
Yeah, thanks, Evan. And we'll land there a little bit past 2 Central. I want to make sure that we stick to our time allotment here. Well, it's like thank all of you for spending some time with us this afternoon. We hope it is a good use of your time and helps prepare you and your committees for what 2025 has in store for us. Any questions that were submitted, we respond to separately and directly. So thank you for submitting questions that you did. And again, best of luck to everyone in 2025. We thank you very much for joining us today. We'll talk to you soon. Goodbye.